Hello, and welcome back to another deep dive. Today is Thursday, February 26th, 2026. And, if you've checked your portfolio this month or even just glanced at a headline,
You're probably feeling a bit whiplash.
yeah, whiplash is a good word,
Yeah.
or maybe just deeply confused, because looking at the stack of sources we've got in front of us today, it really feels like the whole crypto world is going through this massive, it's like a messy identity crisis.
Right, yeah. Identity crisis is definitely the polite way to put it. I was thinking more along the lines of a split personality disorder at this point.
Oh, totally. Because on one side of the room, you've got the U.S. government, specifically the SEC and the CFTC, literally rolling out the red carpet. They're shaking
Wow.
hands. They're talking about safe harbors. It's almost bizarrely friendly.
It is.
But then you turn your head and you look at the charts from earlier this month, and we just lived through a flash crash that, well, statistically, it shouldn't have even been possible.
Exactly. And right in the middle of all that financial chaos, the technology itself, especially when you look at AI and Ethereum, is moving faster than it ever has. There's just so much noise for you to filter through as an investor.
Right. And so that is exactly our mission for this deep dive. We're going to cut right through that noise for you. We've got a joint outlook from the regulators that could actually change everything, plus some, frankly, terrifying market analysis from VenX on that crash.
Not to mention the security reports on recent hacks,
Right.
data from Binance, and this completely wild new concept of AI agent arenas that's just exploding.
Yes. So the main thread we want to pull on today, the thing tying all these sources together, is really maturation.
Yeah, growing pains.
Exactly. It doesn't always feel like maturation when you're staring at huge red candles on a price chart, but the industry is hardening. It's putting on a suit.
Even if the suit is a little bit tight right now.
Right. So let's talk about the people trying to tailor that suit. We need to start with the regulators, the quote-unquote adults in the room, because for the last decade, the whole narrative has just been this endless turf war between the SEC and the CFTC.
Oh, absolutely. It was mom and dad fighting over who gets custody of the crypto kids.
Exactly. But now we're looking at reports from this joint event at the CFTC headquarters. You had SEC Chairman Paul Atkins and CFTC Chairman Michael Seelig sitting down together, and the vibe wasn't hostile. It was actually cooperative.
Which is a massive, massive pivot.
Yeah.
They're openly calling this the end of the turf war. They've launched this initiative called Joint Project Crypto. And the big headline here isn't just that they're in the same room talking. It's that they are actively harmonizing.
Harmonized.
Yeah, they want to create bright lines so that these companies finally know exactly which lane they're supposed to be driving in.
Okay, but I have to play the cynic for a second here, because we have heard the word clarity tossed around for years. And usually when a regulator says clarity, what they really mean is, we're going to sue you, and here's a detailed list of why.
Right, regulation by enforcement.
Exactly. So is this actually different, or is it just the same old trap, but with better PR?
No, looking at the source documents, this does look fundamentally different. And the best evidence for that is this new concept they're officially floating, which they call the innovation exemption.
The innovation exemption, which honestly sounds a bit like a hall pass.
In a lot of ways, it is a hall pass. It's a proposed temporary safe harbor. The details in the stack show they want to allow tokenized securities to trade on, and this is their phrase, whitelisted decentralized systems.
Okay, whitelisted decentralized systems. That is a lot of syllables. Break that down for us.
Sure. So imagine a company wants to issue a token, and that token acts exactly like a share of stock. In the past, the SEC would step in immediately and say, no, you can't trade that on a blockchain. That's an unregistered exchange. We'll see you in court.
Right. Instant lawsuit.
But now, with this innovation exemption, they're basically saying, okay, we recognize the technological benefit here. We see the value of instant settlement on a blockchain. So if you follow these specific, rigorous rules, if you're on the whitelist, you can actually experiment with this tech for a set period.
Without the hammer dropping on you on day one.
Exactly.
You-
While the final rules are still being drafted.
So they are finally acknowledging that the underlying tech offers something that, say, the New York Stock Exchange just doesn't.
That's the huge takeaway here.
Yeah.
And it directly aligns with the broader political backdrop mentioned in the sources. President Trump's stated goal to make the U.S. the crypto capital of the world. And regardless of how anyone feels about the politics, strictly from a policy perspective, you can't be the global capital of this industry if your agencies are regulating every single startup right out of existence.
It really reminds me of a horribly messy divorce that somehow, miraculously, turns into a highly productive co-parenting relationship.
Yeah.
Like they finally realize that if they just keep screaming at each other across the kitchen, they're just going to traumatize the kids, which is the market in this case.
That's a great analogy. And because they're cooperating, they are finally building a real taxonomy. They're sitting down and defining the buckets. What exactly is a digital commodity? What is a collectible? And most crucially, what is a tool versus a security?
Yes. That distinction right there, tool versus security, that is the holy grail for this space. Because if I'm a developer, knowing which bucket my code falls into determines whether I'm building a software startup or operating an illegal, unregistered bank.
Exactly. If you're building a hammer, you don't need a banking license to sell it. But if you're selling fractional shares in a hammer factory, you absolutely do. And for 10 years, the government basically refused to hand out the dictionary that defined those two things. Joint Project Crypto is them finally publishing that dictionary.
Okay, so the regulators are calming down, they're getting rational, but the market itself, the market decided to have an absolute heart attack earlier this month. We really need to talk about February 5th.
Yes, the crash.
Yeah, we have this market analysis from VanEck, and the numbers they put out are just staggering. They categorized the February 5th drop as a negative 6.05 sigma event. Now, I took statistics in college, but I scraped by. So for everyone listening, translate negative 6 sigma into plain English.
Okay, think of a normal bell curve of probability. A 3 sigma event is already considered incredibly rare, like a once-in-a-generation market shock.
Okay.
A 6 sigma event. Mathematically speaking, that is a once-in-a-million-years type of statistical anomaly. It means the price of Bitcoin moves so far and so violently fast that based on all historical trading data, it shouldn't have even been possible.
Wow. And VanEck literally ranked this crash right up there with the COVID liquidity crisis in March 2020 and the FTX collapse.
They did.
But here's the part of their report that kind of made my blood boil when I read it. They referred to this catastrophic crash as orderly deleveraging.
Orderly.
Yes, orderly. I was watching the charts that day. It was just a vertical red line. Real people lost absolute fortunes in minutes. How can a major Wall Street firm look at a bloodbath like that and call it orderly? It feels a little like gaslighting.
I completely get that reaction. It sounds incredibly cold. But there's a vital so what behind their use of that term. When VanEck says orderly, they aren't saying it was painless. They're saying the actual machinery of the market didn't break.
The machinery.
Right. Think back to 2022. When prices crashed back then, major lenders went totally bankrupt overnight. Exchanges halted user withdrawals. The contagion just spread everywhere. That wasn't just a price drop. That was a fundamental structural failure.
Right, the plumbing burst.
Exactly. The plumbing burst. But this time, on February 5th, the plumbing held. Yes, the price dropped violently because an insane amount of leverage was getting flushed out of the system. Margin loans were getting called. Trading algorithms were panic selling.
But the core infrastructure worked.
The exchanges stayed online. The major lenders didn't collapse. In fact, VanEck points out that the realized volatility right now is sitting around 38. During the 2022 bear market, that number was over 70.
Oh, wow. So even though the speed of the drop was historically unprecedented, the market as a whole is actually safer.
It's structurally much more robust. It hardened. The over-leveraged weak hands were washed out completely, but the foundation stood tall. And there's another really wild statistic from their analysis. Bitcoin is currently trading negative 2.88 sigma below its 200-day trend.
Okay, again with the sigmas, what does the trend line mean here?
Just think of the 200-day trend as a giant rubber band attached to the price. Usually the price wanders around but stays fairly close to it. Right now, that rubber band is stretched so far down, negative 2.88 deviations, that in the entire recorded history of the asset, 0% of the time has it been stretched this far without violently snapping back.
Meaning, basically, the selling is completely exhausted. There's literally nobody left who wants to sell at these prices.
That is exactly what the math is suggesting. It's a complete statistical dislocation from reality.
And you know what? It seems like we aren't the only ones looking at that math. Because while retail investors were panic selling during this quote-unquote orderly crash, institutional money was apparently backing up the truck.
The divergence there is absolutely fascinating.
Let's pivot to Ethereum because this shows the other side of the coin perfectly. We pulled data from Binance and Sosa Value. Yesterday, February 25th, Ethereum spot ETFs recorded $157 million in net inflows.
In inflows. That's the key.
net inflows, zero outflows across any of the funds. Fidelity's ETH fund alone scooped up nearly $62 million in a single day.
And that right there is the signal cutting through the noise. You have this historic, terrifying crash. Retail traders are hiding under their desk, but BlackRock and Fidelity are calmly buying $157 million worth of exposure.
They aren't looking at a Six Sigma drop as the end of the world. They're looking at it as a clearance sale.
Exactly. It's the classic smart money versus dumb money dynamic playing out in real time.
But why Ethereum specifically? Bitcoin is the undisputed big dog. Why are these traditional finance giants piling into ETH?
Because they're looking at actual real-world utility. We have a great report in the stack today from Disruption Banking that asks a really blunt question. Is Ethereum actually a working technology, or is it just a casino chip?
Which is a very fair question to ask.
Very fair. And the answer is right there in the usage data. They're tracking 2 million daily transactions, 400 million unique addresses. But the absolute most important number is the cost. Gas fees, the cost to use the network, are currently hovering between just 10 and 20 cents.
That is massive. I mean, I remember the bad old days in 2021 when you'd try to buy a $20 NFT and the network would charge you $100 in gas fees just to process it. 10 cents changes the whole paradigm.
It completely changes the business model. It makes the network viable for actual daily commerce, rather than just high-stakes speculation. And the technical roadmap backing this up is huge. We have to talk about the Glamsterdam upgrade.
Glamsterdam. I swear these developer upgrade names are getting entirely out of hand. It sounds like a really expensive nightclub in the metaverse.
It really does. But it's actually an incredibly serious upgrade to the Layer 1 network, coming in the first half of this year. And the marquee feature they are rolling out is called parallel transaction execution.
Okay, you're going to need to explain that one to me like I'm 5. Or, better yet, like I'm an adult running on very little sleep and too much coffee.
Fair enough. Okay, think of the current, older version of Ethereum, like a grocery store that only have one single checkout lane open.
Okay.
It doesn't matter if you're just buying a single pack of gum or if you've got a cart overflowing with a whole Thanksgiving dinner. You have to wait in the exact same line behind the person in front of you. And if they're moving slow, the entire network is moving slow.
Right, and everyone despises that grocery store.
Exactly.
Okay.
Glamsterdam essentially opens up 10 automated self-checkout lanes simultaneously. As long as you aren't trying to purchase the exact same apple as the person next to you, you can both check out at the exact same time. That's parallel execution.
Oh, I get it. So it's not just that they're making the single lane faster. They are structurally redesigning the network to handle entirely different volumes of traffic.
Precisely. They are raising the block gas limit to over 100 million. They're aiming to handle hundreds of thousands of transactions per second. It is the transition from a cool prototype to a genuinely functional global computer.
And that underlying technical reality is probably why the price predictions from the major banks are so wildly all over the map right now. I mean, in the sources, we saw Standard Chartered calling for a potential dip down to $1,400 before rebounding to $4,000.
Well, Citi is outright predicting a jump to $5,440.
Right. It feels like the boring, actual technical work is finally catching up to the years of hype.
The variance in those price targets just shows that traditional analysts are still uncertain about exactly when the broader market will price in this new utility. But the core fundamentals, the low transaction fees, the parallel execution, the massive ETF inflows, those are objective facts.
Which perfectly transitions us to a set of facts that honestly feel like science fiction.
Yeah.
We really need to pivot to the weirdest, most fascinating part of our research stack today.
The convergence.
Yes, the collision of AI and crypto. We have been hearing thought leaders talk about this theoretical convergence for years, but looking at this press release from PR Newswire, it's not theoretical anymore. It's happening right now on a platform called AIXC Hub.
We'll go a step further. I think this is the most significant story we've looked at all week, even eclipsing the market crash. This platform is actively bridging Web 2 and Web 3, and they already boast 4.8 million registered wallets.
And the craziest part? 3.7 million of those addresses were added just in the last month alone. That is viral, exponential growth. But they aren't just launching another digital wallet. They're launching an environment called Agentia.
Agentia. Yeah.
Now, they describe Agentia as a competitive arena for AI agents. And I'll be honest, when I hear the phrase AI agent, my mind immediately goes to like a customer service chatbot that accidentally cancels my flight when I ask it for a receipt. What are we actually talking about in this context?
We are talking about highly autonomous software entities. These are AI agents designed to execute complex tasks, make independent decisions, and actively interact with the digital economy. Agenteer is built as a benchmarking environment for them.
Benchmarking meaning testing them against each other.
Exactly. Think about the current Web 2 AI landscape. Whether you're using ChatGPT or Gemini, it is incredibly difficult to know which underlying model is actually better at a highly specific task. It's entirely a black box.
You essentially just have to blindly trust whatever the tech company's marketing department tells you.
Right. But Agenteer flips that. It allows everyday users to initialize completely blank AI agents, explicitly define their operating parameters, and then deploy them to battle or run tests in simulated economic scenarios.
So it literally is like a digital coliseum, but the gladiators are software bots.
Yes, a coliseum, but with a highly practical purpose. Because this entire arena is hosted on the blockchain, the test results are completely immutable. You get cryptographic, undeniable proof that this specific AI agent running this specific code achieved this exact result.
And that is the real so what here, isn't it? It's solving the trust issue.
Absolutely. In a digital world that is becoming entirely flooded with AI-generated content and autonomous bots, how do you mathematically verify competence? The blockchain acts as a time-stamped, completely unforgeable report card.
But wait, it goes deeper than just a report card. Because if these agents are operating on a blockchain and they have their own wallets,
They can hold assets.
they could own money.
That is the new frontier we are crossing right now. Those 4.8 million registered wallets we mentioned. In the very near future, a massive chunk of those might not be controlled by humans at all. They will be controlled by the agents themselves. We are transitioning from a world where humans use AI as a tool to a world where the tools become independent economic actors.
That is genuinely mind-bending and frankly a little terrifying, because if we are actively giving autonomous software the ability to hold capital and execute financial transactions, we desperately need to talk about security.
Oh, without a doubt. Because the quote-unquote bad guys are adopting this high-tech at the exact same speed as the good guys.
The Wild West days of crypto aren't over. The outlaws just upgraded their computers.
Well said.
Looking at the security reports in the stack, we have the TrueBit platform hack. It happened on January 9th. It was the first major catastrophic breach of 2026. $26 million wiped out.
Which is roughly 8,500 Ethereum. And look, losing $26 million is incredibly painful for that platform, but it's the broader context from the Chainalysis report that's the real wake-up call here. In 2025 alone, illicit addresses received $154 billion.
Wait, I need to stop you there. 154 billion. With a B.
With a B.
That isn't just a criminal underworld anymore. 154 billion is the GDP of a mid-sized European nation.
It's crime on an industrial scale. We have to stop picturing lone wolf teenagers in hoodies guessing passwords in their parents' basements. The crypto crime landscape is fully professionalized. We are talking about state-sponsored syndicates.
Right. The report specifically calls out North Korea.
North Korea, and massive Chinese money laundering networks. They specifically identified a platform operating out of Cambodia called Huonie that has just become a centralized hub for moving this illicit volume.
So we are dealing with organized crime syndicates and rogue governments. That entirely explains the sheer scale of the numbers. And honestly, it's that underlying fear. The creeping dread that the whole system is rigged by bad actors that feeds the rumor mill when things get volatile.
Oh, absolutely. Fear is the ultimate catalyst for FUD.
Speaking of FUD, we saw those massive rumors exploding across X recently. People were absolutely convinced that Binance was totally insolvent, claiming that the big 1010 crash back in October 2025 had secretly wiped out all their reserves.
Now, this right here is the perfect case study on why you have to ignore your social media feed and look directly at the blockchain. We have a fact-check report from CCN in the stack that completely mathematically debunks this insolvency rumor.
So, just to be crystal clear, Binance is not broke.
The math emphatically says no. The on-chain data proves they are currently holding 659,000 Bitcoin. Furthermore, they operate a strict proof-of-reserve system that transparently shows a one-to-one matching of all customer assets.
It's the ultimate application of verify, don't trust.
Precisely. The rumors were incredibly loud, and they were obviously fueled by the sheer panic of the market volatility, but the blockchain itself is perfectly transparent. If customer funds were actually missing, we would be able to see it on the ledger. Or, more accurately, we wouldn't see it.
Right. Well, before we entirely wrap up the scary section of today's deep dive, I think we have to mention the one single entity that might actually be scarier to investors than a North Korean hacking syndicate.
Let me guess. the taxman.
The ultimate regulator. Yes, we have a quick note here about the new DC-8 rules over in Europe, which admittedly sounds like an astromech droid from Star Wars, but it is actually a highly aggressive tax directive.
And it is a massive deal for anyone listening who operates in the EU. As of January 1st, 2026, crypto asset service providers, so your exchanges, your custodians, your brokers, they are now legally required to report user transactions directly to the local tax authorities.
So the old era of just quietly flying under the radar, making a few trades in Europe without anyone noticing, that era is officially dead.
Completely dead and buried. If you're trading on any centralized exchange within the European Union, the tax authority has your receipts. But really, it's just another layer of that overarching normalization theme we've been talking about.
Yeah, the suit getting tailored.
Exactly. The market is slowly but surely being integrated into the standard global financial system. And that comes with all the tedious tax and reporting baggage you'd expect.
All right, let's zoom out here and try to synthesize this whole picture for everyone, because it is an incredibly complex landscape. We've got the U.S. government, specifically Atkins and Selig, finally sitting at the same table, harmonizing the rules and carving out a safe harbor for real innovation. We have a market that just took an unprecedented Six Sigma punch straight to the jaw and somehow managed to stand back up without the underlying plumbing bursting. We have mega institutions completely ignoring the retail panic and aggressively buying the dip on Ethereum. And on top of all that, we have this rapid explosion of AI agents stepping into the arena, totally verified by blockchain tech.
It paints a picture of extreme resilience. That's the word my mind keeps returning to today. Resilience. The violent volatility is obviously still there. That is just the nature of this beast. But the underlying infrastructure is hardening. The tracks are being upgraded to support actual global commerce, not just casino speculation.
It really feels like we are finally exiting the experimental phase of this technology and firmly entering the deployment phase. The toys are finally becoming tools.
I think that's a very fair assessment.
Oh, I hear a but coming.
There is one final, somewhat provocative thought I want to leave you with today. We spent time talking about Agenteer and these highly autonomous AI agents. And we also talked about how human regulators are finally harmonizing the rules of the road.
Okay, I'm following.
Just think about the trajectory we're on. We already have 4.8 million wallets registered on this AI hub. We have software agents that can be mathematically verified and benchmarked for financial confidence. We are rapidly moving toward a financial ecosystem where AI agents hold their own assets, own their own wallets, and trade completely autonomously based on self-generated algorithms.
Wow. So the primary market investors of, say, 2030, they might not even be human beings.
Exactly. If the global market eventually becomes dominated by millions of AI agents executing hyper-complex trading strategies at the speed of light, do traditional human regulations even apply anymore? How does the SEC serve a subpoena to a decentralized piece of code that independently decided to short the market?
That is a slightly terrifying but absolutely fascinating thought to end on. We're spending all this time building the rulebook for a game that is ultimately going to be played by robots.
We might need to establish an entirely new agency for it, the Securities and AI Commission.
Well, on that slightly dystopian note, we will leave you to ponder the inevitable rise of the robo-traders. Thank you for taking this deep dive with us today. Remember, don't let the short-term volatility scare you out of the market, but definitely keep your eyes on the horizon.
Stay curious, everyone.
We'll see you next time.